Welcome to the Investing Mastermind Podcast. I'm Michelle Markey.
And I'm Sina Lundholt.
And today we're going to continue the lessons we learned from the Berkshire Hathaway annual meeting that happened in Omaha, Nebraska. And if you're interested in listening to some of our prior episodes around this topic, feel free to do so because this is part of that ongoing series. And today, Sina, what was another takeaway that you had that you want to start us off with?
I want to start out with a question that Charlie Munger actually got. And Charlie Munger, if it's the first time you listen and don't know Charlie Munger, he is Warren Buffett's business partner, really transformed Buffett's investing strategy. So this question was for Charlie, and the person who asked the question asked, you prefer to hire someone with an IQ of 130 who believes it's 120 over someone with an IQ of 150 who thinks it's 170. And at that time, Charlie Munger, you were referring to Elon Musk. Given the recent success of his ventures, do you still believe Elon overestimated himself? And that was the question for Charlie Munger. And the answer to that question, basically what Munger and Buffett discussed, was that there's a big difference in what Elon does versus what they do. That Elon is a brilliant guy and he dreams about things, and his dreams have foundation and they do actually materialize into something. What Munger says is that he likes taking on the impossible job and doing it. But Munger also said that Buffett and Munger are different. They are looking for the easy job that they can easily identify. And Buffett says, if we can do it playing tic-tac-toe, we will do it. So Buffett and Munger really likes the easy way out. And they say that's basically where they're different from Elon, that, is very dedicated to solve the impossible and actually sometimes will do it. And I thought that was very interesting for us as investors to remember that Warren Buffett and Charlie Munger really wants to keep it very simple, and we should remember to do the same and not overcomplicate our investments.
Yeah, like for sure. I mean, it goes back to the concept we've talked about before of circle of competence, where what Warren Buffett has stressed to people before is he tries to only stay within his knowledge area. He doesn't try to go beyond it. So someone like Buffett isn't suited to trying to figure out SpaceX and trying to launch a rocket into space. He doesn't necessarily have the same kind of engineering brilliance that someone like Elon Musk does, where Elon Musk is like a brilliant mastermind kind of guy. He's just super knowledgeable about pushing science to the new limits. And Buffett and Munger are not those kind of people. They take, more basic existing knowledge and try to make investing decisions based on something that's much easier to understand. So, you know how they say, like, you don't have to be a rocket scientist to figure this out. So that's what most of us should also try to think about when it comes to investments. Like, we don't have to be the smartest. We don't have to be the best at certain things. We just have to know what we know. And if we feel like we understand that knowledge that comes easily to us, then we can make better investment decisions on that.
Yeah. And I think it's the first time Buffett and Munger actually speak so kindly about Elon, because they have been after him in the past. And I think what they found out is, that they're different, that his lifestyle wouldn't fit Buffett and Munger. And they say, well, it's very likely that what we do, it would most definitely not fit him either. Elon probably didn't want to be in their shoes. And, if you want to look up an interview with Bill Mayer, you can do that. He recommends an interview of Elon Musk that was done about a month ago. So try to look that up on YouTube. Michelle, you talked a little bit about circle of competence, and that's actually the next point I want to bring up, because with circle of competence and with mode, I believe that maybe I've complicated a few things, and that's where in this annual meeting, Warren Buffett actually said something really, really important that I listened to. And what he said is that he's really looking into consumer behavior.
Mm-hmm.
What they do is, and he has said that the whole time, they're looking for certain kind of businesses. And I know that in the past he's mentioned consumer monopolies as a type of moat that he was looking into. But what he said this time is that, well, he doesn't know much about the technical things inside an iPhone or how they necessarily 100% run their business. What he knows is when he sees a certain kind of consumer behavior, that's what's interesting to him. And what he said is that people would rather give up their second car than their iPhone. And that's an indicator to him that the iPhone is such a strong thing in our lives. When we want to own that rather than a car that can take us to work, then it's definitely something that he wants to invest in.
Right.
So I found that really interesting, because I've maybe looked at KPIs and I've looked into the industries I know from my own career, that was in my circle of competence rather than looking at consumer behavior.
Mm-hmm. Yeah, it definitely is interesting. And I wonder if he would say the same point of, are people willing to give up their first car for an iPhone? Haha, like, which is then more important. Would people rather get on a bus and take their iPhone, or would they rather get in their own car, their own fancy Tesla, and go from point A to point B, maybe? I don't know. It's kind of a little funny juxtaposition, but yeah, it's definitely a very valid point. And it goes back to what we're also talking about earlier of not making it too complicated. Of there's so many obvious things in our everyday lives that work well and we rely on so much every day. Like, as another point to Apple, Berkshire Hathaway in the latest 13F filing loaded up a lot on Hewlett Packard, the
Mm-hmm.
maker of computers and printers. And it's
Yeah,
like, what's so impressive about Hewlett Packard? Like,
exactly.
it's not as sexy as something like semiconductors that a lot of super investors were piling into. And then
Mm-hmm.
now they're backtracking because of all the geopolitical concerns that I talked about in a little bit in a recent video, reflecting on the latest stock holdings of super investors like Lee Lu and Monish Pabrai and Guy Spear and so on. The
I
fact that,
also think we actually talked about it in a previous episode. I think it
yeah,
was episode 7 or something like that.
yeah, we also, yeah, talked about some of that, but it's just interesting, like something boring, you would think like a computer maker like Dell and, Microsoft also is making their own hardware as well lately. So it's kind of like you would think this is like a boring, .com era kind
Mm-hmm.
of stock, but maybe there's something that's so obvious and so simple that Hewlett Packard is doing a good job making money in just, continuing to chug away and do well financially. So definitely it's interesting to just stick with a kind of like the easy stuff, not make it too complicated. Like when you were mentioning the key performance indicators, like maybe we could go down a rabbit hole of, like, say, fancy database companies like Oracle or Snowflake or other cloud providers, or, Salesforce, but maybe those are more complicated to understand. I don't know, what the indicators are for those companies as to how we can tell if they're doing really well or not. But it's just a reminder for us to try to simplify the investment case as much as possible.
Yeah, I can definitely also share with the listeners that I might have complicated things with my investing practice in order to actually, of course, I still do believe it's important to know, the business and the KPIs and things like that. But I was pivoting that way too much over to moat type landscape versus actually, looking into the good old moats that Warren Buffett constantly is talking about, the consumer monopoly and price mode and secret mode, etc. We actually discussed moat and circle of competence in a previous show, and you can find it in the overview of all our episodes. Look for moat and circle of competence. So if you don't know those two concepts, you can go back and just listen to that and get introduced to it, because it would take too long to introduce you to it right now. But for me, I have definitely overcomplicated things in trying to look at the industries I've been in and how the companies were structured, rather than, for example, looking at the end user behavior. So for me, this was a really, really important thing I learned at the Berkshire Hathaway meeting, and is something that I'm going to take to heart and actually focus on in the future. And a good reminder, and that's why it's so important to listen to what he's saying during that meeting.
Absolutely. And sometimes what we can notice with consumer behavior is something that you can also notice with your children or teenagers, of the kinds of products that they're really into. Like, for example, I've heard a lot of Gen Z is really into getting their Starbucks. And guess what? Starbucks has been doing better lately. Of there was like a point where they had a bit of a low with the CEO transition, but it's still very popular among consumers, and the next generation of young people are really into Starbucks. So it's a very obvious sign that Starbucks didn't go away during the pandemic. It was as strong as ever, with lines of cars going through the drive-throughs of Starbucks getting their daily caffeine fix. And it continues to be a very popular consumer choice. So things like that are just so obvious sometimes. And I also feel similarly to you, Sina. Like, I make it more complicated than it has to be. Like, I shouldn't, be stubborn and think like, oh, I can buy this particular stock at an even lower price when the recession comes. But sometimes if it's on sale enough, I should just be okay with it and just
Mm.
maybe consider going into it. Like, also, we talked a little bit before the call of how Berkshire Hathaway itself, there has been some concern of what will the future be like with Berkshire when eventually the sad day comes, when Buffett and Munger might not be on this earth anymore. And then there's also going to be another CEO transition to the future CEO, Greg Abel. So with him taking the reins someday, I'm sure maybe the stock will go down initially, the price, because people are feeling a little uncertain about what the new regime is going to be like. But then perhaps that could also be a great buying opportunity into that stock, right?
I am definitely going to buy the stock when Buffett, hopefully it's going to be many years from now, but it's getting closer. He's 92 years old, so there will be an end at some point. And I would definitely buy the share once he passes. Also in the meeting, actually, they did discuss this thing as you just mentioned. So there was a shareholder that was really worried that someone would buy up these shares that, when Warren Buffett passes away and he will give his stocks to charities. There was definitely a concern that these charities, in order to be able to operate, they would sell their shares, and then maybe some activist shareholder would buy up the shares, like an individual or a group would buy up these shares in order to take control of Berkshire Hathaway and do some, what the shareholder said, some reckless behavior, I believe, or be greedy and reckless. He was really worried that that would happen the day that there would be no Warren Buffett anymore. And the answer that Buffett has for that would actually be that it would take $1 trillion to $1.5 trillion to get the voting rights of Berkshire Hathaway. And that limits the group of who is actually able to buy up shares. And I think that was a really, really important point. And it also made me realize, oh my goodness, this company is just one of the biggest companies in the world, and everything is going to be all right. Greg Abel, he was taught by Warren Buffett, and Warren Buffett created Berkshire Hathaway in a way, or structured Berkshire Hathaway in a way that this business can be run by an idiot, like he says, for a very long time and still do good. They have very, very capable managers for all of their businesses. So it's going to take a very long time before it wouldn't potentially go well anymore. So I do believe in the company, and I would be the first one out there when everyone else is selling their shares.
Yeah. And I mean, the only scenario that I'm more concerned about is I feel like there's not too much to worry about with Greg and Ajit continuing to be the future of the company. But then the people who are after Greg and Ajit, are those people as talented or ready? And I think some shareholders were also asking that question of, who would be
Yeah,
the successors
second in
to.
line.
Yeah,
Mhm.
exactly. But they kept that either a secret or they didn't want to say. To me, it's that future, what if something happens, God forbid, to those two, you would
Yeah,
hope not.
Warren Buffett said that's up to Greg at that time, who would be second in line. So yeah, he didn't want to comment on that, but that's right. There was another shareholder that actually picked up on that.
Yeah, because maybe they have identified some potential successors to even those two, but they just want to keep it a secret because maybe they don't want those talented people to get poached away or whatever from other companies that want talent. But yeah, hopefully, like, I think you definitely need someone talented to run the insurance business. Like you can't just have any Joe Schmo run the insurance like that. You definitely need someone as good as a Jeet. But I think for a lot of the other operating businesses, they're run by extremely capable managers, a lot of whom were the original owners of those businesses. So if I had to guess, it feels like what Greg is overseeing seems a little bit easier than maybe the insurance side, which seems a little bit more, like finesse is required. And yeah, even though, we're talking about who are these potential successors, in spite of all that, I know that Charlie Munger at the Daily Journal Corporation's annual meeting in February this year, he said that Berkshire Hathaway is available at a great price around here, and he thinks it's a good buy. So at that time, it was probably around the low 300s, and the last I checked, it was at about $333 a share per Berkshire B share. I don't really keep track of Berkshire A because it's not like I can buy that one. So
Yeah,
I
it's like
only
500K right now or something
maybe
like that.
something
So
like that. Yeah, I only look at the Berkshire B, but apparently, supposedly, according to Charlie, it's a good deal. Whereas, I remember him last year saying that he wouldn't buy Costco at the prices Costco was at because it's just way too much. But if you're a pension fund or institutional fund and that's the next best thing, then, it's okay to buy it for them. But for everyday people, he didn't even think Costco was on sale. So for Charlie to say that he thinks Berkshire is on sale, that's, in my opinion, saying something. And also, there's other great investors who have studied Berkshire stock, like Chris Bloomstrand and Adam Mead, and they have their own valuation calculations of Berkshire. And according to Chris Bloomstrand, I think I haven't looked at the source material myself, so this is just what I've heard from other people. But supposedly, Chris Bloomstrand values Berkshire at maybe $400 per share. So if you think that is its intrinsic value currently, then Berkshire might be on sale at 330 or so. So, even though I would love to get Berkshire at even lower prices, like below $300 per share, there's still definitely way more upside. So not that this is advice, like I'm not recommending anyone buy the stock, but it's just some food for thought to think about and consider the possibility of if Berkshire might be even on sale even now. And therefore, it wouldn't be surprising if Berkshire Hathaway continues to do stock buybacks, or also known as share repurchases of their own stock, because it's currently available at a good deal and it's maybe below the intrinsic value that Buffett believes it is. So, yeah, it's good things to keep in mind there.
yeah, I'm going to jump to another topic now, and it's the banking industry, because there's so much, and even on this podcast, we've been talking about banking, and of course, it was brought up at the Berkshire Hathaway meeting. One thing that Munger said, which I thought was interesting, was that bankers should be more like engineers, more focused on avoiding risks than getting rich. And he said the thing that is happening and has happened since this is particularly the 1990s, is that banks are now also investment banks. And after the crash in 1929, banks could no longer also be investment banks, but then that changed around again. And that Buffett and Munger really believes that the source or the root of why everything has gone wrong with banking in the United States is that there's so much greed, and the bankers, especially with investment banking, are trying to get rich instead of some of the old values from banking. And where Buffett says that you can be innovative in banking, but at the same time you should have some old school values in order to run a bank. And they like banks and they are invested in banks. They just bought more Bank of America shares, we could see in the latest filing of what they bought. And so they do love banks, but they also say that there is something in the banking system that just does not work, and is particularly the mix between, normal deposit services and investment banking. So I just thought that it was a really, really interesting discussion that they had, and something that regulation should look into, that banks shouldn't be investment banks. It should be divided so that we don't see banks being all crazy. He actually also said that with First Republic, he had been looking into their 10K, which is their annual report, and that he could see that they were offering non-government guaranteed mortgages, and that they were just, doing some crazy jeopardizing the business. He could see it coming. So that's also really, really interesting for us as investors. Again, we have the opportunity to look into these annual reports and actually finding out if businesses are good businesses or not.
Yeah, and you can see the results of some of these banking bets that Berkshire and other super investors made. Like, I think some people also bought Bank of America, similar
Yeah,
to
Mike Burry.
Yeah, like Lee Lu bought Bank of America and also this other bank called East West Bancorp. So people
Interesting.
agreed with Buffett that Bank of America is apparently still a good bank. In addition, Berkshire also bought some more, Citigroup, and also for the first time Capital One, but they either reduced or they sold out entirely from Ally Financial, Bank of New York Mellon, and US Bancorp. Yet people like Charlie Munger in Daily Journal, they still held on to US Bancorp. They didn't sell any of their bank stocks. So it's interesting how Berkshire, they're kind of separating them, like they're separating the wheat from the chaff, like where they're saying, okay, these banks are good, we like them, and these other banks, we don't trust it as much. So it's interesting where you can start seeing there's differences in quality. But even though we know JP Morgan Chase bought First Republic or took it over as part of First Republic going down the drain, but yet that still didn't make Berkshire Hathaway buy JP Morgan. So it's interesting how even though Buffett is such good buddies with Jamie Dimon, it wasn't, enough of an investment case for even Berkshire to buy JPM, even though now it's one of the biggest, if not the biggest bank in America. So it's interesting to me that you try to study and figure out what is the rationale behind why these super investors are buying certain banks, but not buying other banks during some of this time. And yeah, it's definitely something to be careful of, because even though Michael Burry bought a bunch of banks, one of those was also a $2 million bet on First Republic. And I'm guessing that might not have worked out for him, that one, but maybe the other ones did super well. And they more than offset the fact that he had made that First Republic investment as well.
Yeah, it's definitely very, very interesting to follow, and also admire Buffett for saying that he believes that the CEO and management of these reckless banks, that they should suffer the consequences. I think that's a really, really bold statement that we don't hear from a lot of other CEOs. I think he's right that there should be consequences, and we see that in other parts of the world that there are consequences for people that are creating havoc to the system. So
Right.
so
Yeah, they shouldn't just get a golden parachute.
No, exactly. And that's, he did mention that that's happening a lot, that they get away with this and the shareholders suffer, and it shouldn't be like that. So
Right. Yeah, it's like just because you have a bad manager, why are they bringing the whole ship down? Like, it's kind of, there should be better checks for that. Like, it ultimately, in addition to the manager, like the CEO doing a bad job, it's also the board of directors' fault when sometimes there's a breakdown like that, of they should have been keeping better tabs on what the management was doing. And they're supposed to be responsible to the shareholders, and if the board of directors is failing the shareholders, then maybe the board of directors also needs to be replaced.
Oh yeah, that's a very, very important point. With that important point, Michelle, we're coming to an end of the show.
For
So thank you so
sure.
much for listening in. Remember that if you like what we're discussing here, you can rate the show in your podcast app. We would really, really appreciate if you did that. Also, feel free to share it with your friends and anybody you think would be interested in listening to an investing podcast. We will
Yeah.
be back with our next show on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts, so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.